Good day, everyone, and welcome to webinar, Admiral Markets and Forex 3 joint webinar. And today I am showing you advanced techniques, entries, and scaling in. And during the webinar, I will also do I will show you forecast for pound yen, and we will go and try to find a specific entry for future position in pound yen. As you can see, I've been very heavily involved with pound yen the last couple of months, and at this point it's definitely one of the best pairs to trade, maybe the best out of all pairs here in Forex market, in my opinion. Much better than all other pairs, including euro dollar and all other major pairs. So before we begin, as always, our standard risk disclaimer. Explain that online education materials are available by Admiral Markets Estonia for a global audience. And please take into consideration that information in this session may not be suitable for everyone. Admiral Markets UK Ltd takes no responsibility for information accuracy. This is solely my opinion. And this webinar is for informational and educational purposes only. And final part, explain that if you proceed further with me, you are agreeing with all that the risk disclosure statement has to say. So we can proceed. What is scaling in? Examples, entries, and forecast and entries. So scaling in is a special technique that you actually made entries in pieces. It's one of the best techniques, in my opinion, for making entries, simply because it gives you a bigger margin for potential entry. As you probably know, or you don't know if you don't follow my analysis, I'm a price action trader, and I prefer to see the zone. I don't particularly look at crosses, EMA crosses. I look at the only indicator and the best indicator that gives me correct price, and that is the price itself. So whenever price enters the zone, I may opt for either a full entry or entry in piece. If I opt for entry that will come in pieces, then we are talking about scaling in. So it's a more calculated approach, and definitely it will give you, it will boost your profits exponentially up if you're profitable, and it will definitely lower your losses exponentially. So it's a very effective technique to use when markets are slow, because if markets are slow, then you will definitely see the advantage of scaling in. One of the best approach to scaling in is to define a zone for your entry and then wait patiently for the price to actually hit the zone. When price hits the zone, then you are ready to either make your entry as a full, with a full risk, or divide your position into separate trades. Keep in mind that proper trading is always about proper risk. No matter how good system you have, if your risk management is bad, you won't be a winning trader. That's the fact, and that's the truth. Even if your system is not that good, believe me, if your system is 30 to 40% accurate and your risk management is good, then you will still be in advantage. Okay? So scaling in uses that margin, that possible human margin error, to effectively compensate for either a worse entry than expected, or eventually it can compensate if your risk is way too low. Now, if your risk is way too low, then you will have a possibility to add to your trades. And it's not adding to losing positions, how many people are referring to that, because losing position is not losing until your stop loss is hit. Think about it, because that is only a retracement within your own position. Okay, so let's say, for example, that market is in uptrend and you have entered at this point. So market actually goes down, right? And here is where your stop loss is. Market goes down. Some people would say this is adding to losers. No, it is not. Because if this is the swing low and this is the swing high, let's say that you have entered at swing high, all these levels here are actually retracement levels per Fibonacci, right? So actually the price is retracing. Even if the price went here and this is swing high, this level here is one of possibly Fibonacci zones, right? So we cannot talk about adding to losers because this is scaling in. As price gets deeper into the zone, you're adding positions. Primary thing to adding positions or scaling in is to keep the risk under control. If you defined your risk, let's say as 1% per trade, you should never allow this to be more than 1%, right? So that is, you need to know, you need to calculate that preemptively. You cannot enter the market with full risk and then add into positions, because if you do that, your trade will definitely be above your threshold, above your risk threshold. Well, I know that a lot of people simply do not follow guidelines, and most people would probably try to trade with a full risk because they effectively, human mind is a gambling mind, right? But if you adopt this strategy, you will see beneficial results on your account, definitely. So adding into retracement is not the wrong way. Adding into losers is. The difference between adding into retracement is that if you add into retracement, you are doing a scaling in. If you add into losers, it means you don't have a stop loss. Now, of course, your stop loss needs to be logic enough. You cannot place 200 pip stop loss on intraday time frames. That means that you are actually not trading intraday. Okay, so you need to have a logic for stop loss placement, and within the logic of stop loss placement, you are effectively adding into retracements. So that is, believe me, guys, if you do this, what I'm teaching you now, what I'm explaining, you will see the difference, and that will be a positive. That will be a positive effect on your account. Now, if you still want to gamble, then you can add into losing positions, make maybe 100% in 1 month, and then in a couple of months, your account will be depleted. Now, we are not talking about gambling, because you know you can gamble in Forex market, and if you do that, you will definitely have a bigger chance for success than gambling in casino. But the point is, why would you do that? You want your money to be safe. You want your trades to be better than you did in the past. And that is why scaling in is a great technique. And this is an example of scaling in. Let's say that total maximum risk for our trade is 0.6 lots. That means that we have calculated that the risk, if we do the risk with 0.6 lots, okay, and we place a stop loss, let's say within 50 pips, that is 1% of a risk. So that is the primary thing. You need to know how to calculate your risk. So 50 pip stop loss and 0.6 lots entry. So we have calculated that it's 1% of our account. So it's good. Of course, this depends always on your account. This is just an example. So first entry, instead of taking 0.6 full lot size, we will divide our entries. So first entry is at 38.80. We are adding 0.2 at 38.60. Then we are adding another 0.1 at 38.50. And then we are adding another 0.1 at 38.40. So it's total of 0.6 lots, right? 2 and 0.2, 0.2, and 0.1 and 0.1 is 0.6 lots, right? Stop loss is 38.30. TP is at 39.70. Now, if the price goes in your favor and hits TP, you would be making $180 for the first position, $220 for the second position, $120 for the third position, $130 for the fourth position, right? Okay, so see, it's very simple. We use the rough numbers in dollars, so pip value may be different, but let's say that we have used standard pip value. So if you had entered at 0.6 at 38.80, you would have made $540. That's $110 less than by scaling in properly. Okay, you see, you're just, well, this is how you can make your profits exponentially go up. So profits go exponentially up if you scale in. Now, the drawback can be that scaling in will not always work. Let's say that you have entered here and price didn't make any pullback into the zone, right? So instead of making full 0.6 trade, you will take profit with 0.2. That's a drawback, and that is what you need to do it yourself, guys. Okay, I'm teaching you how to fish, and you need to fish by yourself. So let's review the same example. If price hits stop loss instead of profits. So first entry at 38.80, and we are scaling in, okay? And we have, again, total of 0.6 lots. Stop loss is 38.30. TP is at 39.70. So if the price goes against you and hits stop loss, you would be losing $100 for the third position, $30 for the second position, $20 for the third position, $10 for the fourth position. Total of $160. Now, if you had entered at 0.6 with full risk and full lot size in a single position at 38.80, you would have lost $300. That's $140 more than 200. So that is why the loss goes exponentially down if you scale in. So this is a great example, but you need to know first to trade in the zone, how to define a proper zone. If you are not sure about the zone, well, you can always follow my analysis on Admiral Markets and Forex Street. I always post POC zones, and POC zones are actually points of confluence. Those are zones where we actually make entries. Okay, so you need to define the zone. Scaling in, if you don't know where the price might pull back to, is useless. How would you scale in? By using EMA or MA crosses. Guys, I don't know anyone who made money substantially on trading MA crosses. I personally don't believe in MA crosses. I use moving average as support and resistance levels, so dynamic support and resistance levels. Those give me confluence for possible entries, stop losses, and target price. That's how professionals trade. They don't trade by using EMA crosses. EMA crosses can work in a trending market, and everything works in trending market. But as soon as market starts to range, then, you believe me, you will get back to price action. And market is ranging most of the time, unless there is some fundamental event that will make its impact, like Brexit, whatever. So bound crosses are definitely best to trade now. I just analyze euro dollar, make an entry from time to time, but mostly I've been trading pound yen. And yes, you probably know that I was bullish with euro dollar, and actually we made some money, of course, with previous euro dollar setup, but it's nothing compared to pound crosses, especially pound yen, pound New Zealand. So you need to think out of the box, and especially if you trade those pairs that have big range, such as pound yen, pound New Zealand. Pound yen is called dragon, pound New Zealand is called beast. It's definitely suitable for scaling in, and much better to trade than euro dollar and those major pairs. Now, so you need to know your risk. You cannot enter randomly and make money and then repeat and repeat. It will make you lose in the long run. So you need to be totally professional. Determine your risk, calculate your stop loss. Based on your stop loss and risk, calculate your maximum lot size. So let's say that account is $1,000 and risk is 2%. And let's say stop loss is 30 pips. So you use the risk of 20, the risk is $20. Okay, so it's okay. Well, let's say that it's acceptable. It's a small account, very small, usually a starter account, but you need to build it up. So entry could be 0.05, because if stop loss is hit, you would only lose $15. That is 1.5%. I know that it sounds low. It doesn't sound that it's a big and that you can make anything with that. Guys, that is why you should be focused on making pips, not the money itself. Because if you're focused just on making money, well, believe me, you will probably start to lose. So bad way to scale in is if you don't trade with a stop loss and you're heading into your losing position. So that's a bad way. So don't do that. Be focused on pips. Start making pips and money will come after it. So determine the risk, enter exponentially. It's a good method, and it usually requires some mentoring and practice. But the thing is, you don't move your stop loss. You need to, if you want to scale in, your stop loss should be fixed. Because if you move your stop loss, then what would happen is actually you are actually moving your risk. And if you charge your risk up from 2 to 5%, let's say, believe me, you will be in a dangerous territory. I have calculated and I have did some studies on risk management, and I found out that as long as you are within 5% of risk, you should be okay. Or if you lose, you can recuperate, you can make it up. But as soon as you cross 5% of risk, then you will be really endangered. Your account will be in danger territory, danger zone. Okay. So if you decide that your risk is overall risk is 2%, but you need to make 2 or 3 trades, you need to divide the risk between the trades, because you actually decide. The first thing is you need to decide about your daily risk. And then when you decide about daily risk, you're actually deciding about your position risk. Because daily risk is, let's say, 2 or 3%. If you make your position with 2 or 3%, that means that you have already gone, to your full risk potential. And that is not good, guys. That's not good. Because you won't be able to make additional entries. And you will probably notice additional entries, but you won't be able to execute it if you follow your plan that strictly says 3% or 2% maximum. So the first of all is daily risk, and then you need to define positional risk. If you have 3 or 4 position, then divide your daily risk by 3 or 4 position. Now, if you have positions, divide it to include scaling in. Well, that is, it might sound complicated, but that is the way how you can start to win. Your system will do you nothing if you don't know about your risk management. That's simply out of the book. It's not, that is not how you can make money. Just by trading system that is mechanical without any knowledge about risk is the worst thing you can do. So there are a lot of examples. I have it somewhere where I actually analyzed my losing trades, and I have noticed that the only thing that I lose is when okay, we can always have a bad day, bad week, right? But the thing is, if risk is okay, then next week you will make it up and you will make profits. But if your risk is big, then it will take a huge effort to actually come and bring your account to break even. That is the hardest thing I did in my trading career. And actually, it's a very, very hard thing to do. If you lose 30, 40, 50 or more % of your account, then you need to be extremely patient. You need to be extremely accurate if you want to normally bring your account to break even. But if you lose only 10% in a week, well, that's perfect for making your account break even during next week. Because if you know to trade, the chance that you make 10s or 20 consecutive losses is second to none. So it's very hard. So you need to have a good strategy, but even more important is that you know about the risk. So once more, before I move on to live chart, the only proper way to scale in is to determine your risk, calculate your stop loss, and base your stop loss, based on your stop loss, calculate your maximum lot size. So your risk should be determined per day as a daily risk. Then your positions should be defined within those the daily risk limit. And if you want to make scaling in, you actually need to divide your position into multiple entries, multiple pieces, while keeping your risk the same. Okay, and that is what you should do. Let's say that we have determined, this is just an example, and we have determined that our risk for this potential trade can be 0.4, okay? And we actually want to make a long entry because at this example, this was in January, February. Well, this is an older example, but it doesn't matter, just for example. You can see that this is effectively uptrend, W pattern, Marubozu candle. We have a trend line at previous swing, so it's clear that it's uptrend. You don't need to think about it too long. So we actually want to enter the market as with scaling in. So what we do is actually we enter here. This is our first position, and here this is our second position, because the market pulled back within the zone. So if we determine that actually this is the zone that we will make long entries, we have waited for pullback, we entered the first entry, we entered with second entry, but our risk is the same. So that is how you need to divide. So I don't recommend scaling into a winning position, because if you actually, if you scale in here, you would be buying high. Okay, so I never do scaling in into winning position. So let's say that I have entered here and there, and here I'm in profit. So if I enter here, if I add another position, that means that I'm buying high. I don't do that. You need to buy low when you see uptrend, and you need to sell high when you see a downtrend. So it's a worse thing to do, to actually go long simply because market is going up. Well, it can be justified if you see a breakout example. But again, with breakout examples, you need to know where the breakout might happen and where can the price go. So you need to know breakout zone, breakout level. You cannot simply trade daily breakout of daily high just because the price went above daily high. It will work for a couple of times. In the long run, it won't work because you are buying high. Okay, if you do that, it won't work, believe me. So you don't do that. Now, what is also effective way to do? Well, if you see this happening, well, then you need to wait again for the price to enter the zone. And here, guys, you see it went again in the zone and it was bought. Again, it went into the zone. It was bought. It was bought. So a lot of examples, and you can actually divide your entries. One entry here, one entry there, third entry here, while still being within your risk limit. If your stop loss is not moved from this spot. So try to do that. At least try to practice it on demo account. And I think that your live account will be grateful to you if you try this. Believe me, it's an effective way to do. It's not a hard way to do, and you can make a lot of pips and profits by using scaling in. Okay, now this is what I never do, and this is just an example. For example, long euro dollar 37. This is stop loss. This is target price. So if you're 20 pips in profit, you add 0.20, okay, at 37.20, okay. So that means that you trade 0.20 lots more with stop loss 60 pips far. So it means you were buying high and your stop loss is even, it's really far away from your original entry and from your second entry. If the price goes against you, you will lose more. And that's totally in opposite from trend trading. Trend trading is buying into dips, selling into rallies. You cannot trade randomly, okay? You make entries. So this is what I'm showing you is price action. But if you're using, let's say, different systems, then a guy who created a system or your teacher or your mentor should explain you how you can make scale ins. Because I know how I do that, and I'm teaching you, but that's actually price action. It's not it's hard to do that if you actually trade with indicators, because indicators, I don't know, maybe there is a system that can show you zones with indicators like supply and demand, but I don't know about it. I know my price action zones that are based on POC zones, points of confluence, and those are usually 80% successful. You can follow it, you can see what I do, and you can actually read the analysis every day. And the first touch of the zone is the most profitable. That is how we make money and pips. That's price action. About other scaling in, you can maybe do that with indicator system, with harmonic pattern. I think with harmonic it's easier because harmonic also show you possible zones for entries, range bars. But mostly, guys, if you want to make indicator based entries with scaling in, you need to know if your system allows it. If your system simply does not allow you to make scaling in, then I don't know, you will possibly be, you won't be able to make it. You need to ask a creator or a seller of a system if there is a possibility for you to scale in. I don't know. I was showing you how I do it with my POC zones. Okay. Entries can be scalping, intraday, intra-week. So entries are always different. We cannot talk about same entry when scalping, when making intraday or intra-week position. because scalping is done on lower time frames. Intraday is usually intraday time frames. My preferred time frame is 1 hour entry, 1 hour time frame. And for swing trades, I mean intra-week that lasts for 2 to 3 or 5 working days, you actually use mostly you will use 4 hour time frame. You can also go with multiple time frame analysis and so on, but believe me, uh, you need to define your possible trading session. You need to know whether you will scalp, whether you will make intraday position, or whether you will make a swing position. Believe me, it's very important, because if you make scalp entry and market is has made 10 pips or 15 pips and then reversed, the chances that you will lose, because lower time frames such as 5 minute and 1 minute are good for taking fast trades. You can do equity trading with 1 minute or 5 minute or I don't know 2 or 3 minute charts, but it's more suitable for equities. It's not for forex market, except if you're trading with fast moving pairs such as pound yen, Australian dollar yen, pound New Zealand pound, Swissy pound, Aussie, right? For euro dollar, it's nonsense. It's nonsense, really. For small moving pairs, for pairs which simply sit at resistance support, making range moves up and down, it's stupid to make scalp entries and then wait for intraday positions. So scalp entries are lower time frames, unless you have your own method how you can scalp on higher time frames. I don't see the point really in that. And intraday trading is usually 1 hour 15 minutes, usually. Of course, multiple time frame analysis can also be under intraday trading, and intra-week is usually 4 hour. Type of entry can be trend, counter trend, ranging. So if the price is making zigzag, that's trend. If price is if you want to sell on rally, okay, it's a trend. If you want to buy on dip, it's a trend. Counter trend positions are also selling on rallies, but you need to know historical levels of support and resistance to make counter trend opportunities, not just intraday levels, but you need to align intraday and historical levels of support and resistance. Because if the price has rallied from the past, in the past from one point, the chance is that it will rally now moment. Because the biggest advantage in forex market is that price repeats itself. So you need to align it. You need to watch for historical buyers, historical sellers, and align it. And if you want to trade range, then go with ranging pairs, not with pound yen, because pound yen is not ranging. Pound crosses are mostly trending. Find a low range pair, maybe Swiss yen. I don't know. I don't trade ranges usually, but try to find some minor pairs that are ranging, and there will be your opportunity. Don't try to search for ranging entries on pound Aussie, pound yen, pound New Zealand, pound dollar. Now we have a trend. Remember what I told you a couple of months ago? We will sell on rallies, and I'm still selling on rallies, pound crosses. Now, another thing is actually this is what I was saying. Trend entries are made on pullbacks. Okay, this is only for counter trend entries. And what I wanted to show you is actually a live chart, and we will try to find pound yen next possible sell entries. So here, guys, let's try to define a zone here. First of all, you can see that this is actually a downtrend, and because this now is historical support here, Okay, pound yen. Let's see, the low of this candle is 128.66. So we will mark it here, 128.66. Okay, so this is the low. So this is, guys, support. Forget about just pivot points, whatever about those indicators that will show nothing but numbers. This is the avatar of price action. This is the ultimate truth in trading. Look at this candle. So it tells you that 128.66 has been bought in the past. So if the price hits the level, it will be bought probably. Now we can assume that buyers were actually aligned at these points, because this is the low of the body of this candle. This is actually the low of this candle's wick. So this is actually the zone for buying. Okay, I move this, I will align it again. See, so you see the price has been bought heavily here. Watch this. This is where buyers are, guys. Watch this. A lot of rejection in the history. So it's really strange to think that there won't be any buyers. Now the buyers showed up here, and the price spiked up for more than 120 pips in a single hour. That is the strength of those zones, and we use the zones for making entries, better entries. Now I'm not saying that the price will not break this level, but it's very clear, if this level is broken, the price on the dragon will go to L5. L5 is 126.91. Okay, these are weekly pivot points. Okay, let's see if it's, no, it's actually 97. So 126.97, and that is used for making those swing entries. You can go with intraday trades, ultimately targeting these levels, and exiting when price is close to the levels. But the thing is, this is where buyers are, and now we are in retracement, right? So what should we do? It's logical, because we are in downtrend. I don't want to make any counter trend opportunities. Now I'm talking about trend entries. We would either sell if 4-hour closes below L4. So if 4-hour candle closes below 128.66, we should see another sell towards L5, that is 126.97. In the meanwhile, there will be some possible spikes up and then, but this will be the target. 4-hour needs to close below it. If you want to make intraday entry, then 1-hour candle should close below L4, and you can try to find an intraday breakout position. Until this level is broken, 128.66, I would go with sell entries. If you followed my analysis yesterday, I told you that pound yen has confluence points, and I have done the analysis. Now, I also said, if pound yen breaks 130 or 129.70, it will go down, and it happened. It made 70 to 100 pips of a move when it broke 0-0 level. So now we should wait for possible entries, and let's try to find 4-hour confluence. So 4-hour confluence points. First of all, we will define important swing points. So obviously this is important swing point here, because we have a double top-ish price, and it's actually for H4, that is a swing. If this is retracement, okay, if this is retracement, now I'm talking from swing perspective, guys, not from intraday perspective. This can maybe happen later, or this might not happen. But if it doesn't happen, we will be waiting for L4 breakout. So for swing entries, okay, it's very clear. I will zoom in now. We put Fibonacci here, and we need to find historical levels that are important. For that, we need to zoom out of the screen. Do we have some important historical levels? Yes, we do. This is one of them. Okay, let's see. We will zoom in and see a lot of buying, huge buying. But watch now. This level has been broken here, and that is exactly 130.35. So we will mark it here, 130.35. Huge buying in history, guys. It's not just coincidence that this candle has been sold into. You see how the price repeats itself. Now, would this be a good re-entry? Well, guys, because we already had a first rejection here, okay, I wouldn't be so sure. Because usually after first rejection that was good for 130 pips from this level, we might see a break of this level and another retracement. For that, we need to use another confluence point, and another confluence point is here. This is bullish order block here that was broken. This was historical retest with shooting star. It means that historical sellers are here. In now moment, if it happens, this would be a good confluence point. So 131.01 to 131.25. This could be a good entry if this level breaks. Because here we have sellers. Now, I can possibly say this can be a good entry. But it will depend on price momentum, whether the price will target lower levels. One thing is for sure. If we see a clear break of 4 hour below L3 today, next target will be L4. If we see 4 hour clear break below this level, next candle will be L5. Don't forget that pound yen has been sold heavily during Asia session. And sometimes during a strong trend, the bigger the pullback is, the better the trend move is. And we are really talking about strong trend, guys, because we can also place an equidistant channel here and see that price is moving within the equidistant channel in a zigzag motion. And zigzag motion is the example of a perfect trend. Trust pullback, trust pullback. That is how price makes a zigzag. Now, watch this also. L3 has been rejecting the price 4 hour time frame. It means that these, now here we have buyers. And for me personally, if I see 4 hour close below L3, not this is rejection, because last 3 candles in 4 hour time frame haven't closed below L3. But if 4 hour candle closes below L3, that would be a signal to make for a next target, that is L4. But if we see a break above this 130.35 or 35.40, I would be looking to sell here 131 to 131.25. This will be the zone, and there you can try to make so-called scale in entries. We still don't know what will happen, because now it's a bit of when US kicks in, usually Americans buy stocks and equities go up usually. And now I see that equities are up simply because pound yen has been bought from this historical level here, historical zone 129, as we defined it, 128, 129.10. Okay, here. This was historical buying spot, and that means that equities are up because pound yen is heavily related to equities. Now we will see what will happen if we see, as I say, if we see a sell in equities, that will give further momentum to pound yen. and watch for L4 breakout, or eventually next level to short into 131.0, 131.25. Try to go with scale in. I hope that you have enjoyed. I will be here with you soon. I don't see any questions. If there is any question, you can ask me. If not, we can call it a day. I will be here with you soon, guys. As always, I will be on holiday very soon, but in September I will be back. So this webinar is recorded, so you can watch it. If something is not clear, feel free to send me an email. Of course, this is my email, tarantulafx@gmail.com. So feel free to ask me. I will help you. And until next time, cheers, and as always, trade safe.